Hello, traders. Gary Wagner here. 209 in Honolulu, 809 in New York on Monday, 10th day of October 2022. And this is the daily report for gold and silver. A rough day for the precious metals, with gold trading down dramatically, actually opening above 1,700 and closing at 1,674. That is this red line. It once again broke through 1,680, which I believe is a absolutely critical area. It did break through previously, traded down to about 1,624, but it did rally for a while. 1,624 up to about 1,735 on an opening or closing basis. However, you can see this candle here, this long green candle, the tail did go into the 50-day moving average. That's currently at 1731, and that's currently major resistance. And you can also see from there, it failed over the last 4 trading days. We're currently trading up a little bit from the close, not that much, with gold at $1,677.50, up $2.20. Silver also sold off dramatically, breaking through the 100-day moving average at 19.96 cents. It traded to a low just above the 50-day moving average and is currently fixed at 1966.50 per ounce. And the 50-day moving average is just below that at $19.39.4. Traders, today's move was a strong move to the downside, hitting a low below $1,780. That was that key and critical level. But it did affect our stops and our trade. If you recall from Friday, we did enter a long position at 1705. That is right here, and this is the day of the jobs report. That all got eroded today. We had a 30-plus decline, as you can see, and as the market went down, it's up a little bit, but on the daily candle, which is this red candle here, it did stop us out. We had a stop at 1688. That is this red line, and you can see it's about halfway through the total decline of the day. I'm sorry to report that on this trade, we took a drawdown of $17 per ounce. For Forex traders, people trading COMEX contracts lost $1,700 per contract. But the sobering news right now is we're all aware that the Federal Reserve will most likely enact a 0.75% rate hike. Their goal is to get to 4 to 4.5% by the end of the year. That's going to definitely pressure gold because that will take the dollar higher. If you read our opening letter, we talked about a modeling system used by the Federal Reserve Bank of Cleveland, in which they've already put out their forecasts, not only for September, which we'll know about on Wednesday, but for October and the last quarter of this year. What the table shows, and you can take a look at the letter, is that unquestionably inflation will remain persistent, which means the Fed, if they continue with the dogma that they're going to do whatever it takes, they'll continue to raise rates. I'm looking at 5.5, maybe even 6%, because what the data has shown by the Federal Reserve is they are anticipating by the end of the year, we will have core CPI inflation just at around 8%, and more importantly, what the Fed looks at, which is the PCE, which strips out food and energy, at 6.3, and they want it at 2. It's impossible to accomplish a task with their current methodology, and more importantly, the spins from some of the Fed members that they'll be able to instigate this whole thing with a soft landing is a dogma that personally I find hard to believe. We'll have to see if the market holds in an area or wants to go lower. On a technical basis, you have to look at a downside bias. That downside bias really began in March, the first interest rate hike by the Federal Reserve. If we simply put in some channel lines, and this is going to be a fairly rough way to do it, but we look at the series of highs that have come in as well as a series of lows, it's quite apparent We've seen lower highs and lower lows, with this last low coming in really below $1,632. So, where do we look at potential support? This is one area, these lows here. However, if we get a hard sell-off, it's more likely that we will see a full 61.8% Fibonacci retracement from the highs of 2000. So traders, while we're worried about what the September numbers will be for the CPI month over month and year over year and the PCE, the Federal Reserve Bank of Cleveland has not only projected September, but they've also projected October and in fact have information on where they think inflation is going to be by the end of the quarter. And here's what's important. Regardless of the fact that they're saying that they are having an effect, their numbers, not ours, their numbers, and this was done on October 7th, are showing that really you're not going to see a big difference. Year over year, they're expecting October and this month 8.04. More importantly, take a look at the core CPI. They're projecting that through the next couple of months, it's going to remain elevated and well above 6% year over year. That is troublesome, and that is why the Federal Reserve will continue these massive rate hikes, I assume, until they get close to about 5%. What that will do to the economy is to be determined, but it definitely suggests that a soft landing is out of the question and the high likelihood of a recession next year. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.